When you're brand new and learning the ins and outs of options trading, it can be overwhelming. It can be very confusing as far as the difference between a long call and a short call and a long put and a short put. And then you got all the multi-leg strategies like vertical spreads and iron condors and things like that. You know, there's a real steep learning curve to options trading, right? It doesn't take a rocket scientist, but it does take a little time to learn some of these basic concepts. And one of the most basic concepts when it comes to options trading is the concept of rolling a position. And what a roll is when you have an existing options position and you roll to a new position, meaning you roll the strikes up or down in price, or you roll the strikes out in time. This is called rolling a position. And if you're new to options trading, that can seem a little confusing. Why the hell would you want to roll one of your existing positions? Well, there's several reasons why you may want to roll an options position. Typically, they fall into three categories. You're either winning on the position, and rolling essentially locks in some profits. You're losing on the position and you're just trying to give yourself a little more time, really just to break even at that point. You don't want to accept the loss. And if you roll a losing position, typically you just want to get back to break even and get out of the damn thing. And then three, that existing position that you have on really hasn't done anything. Now, I would say that's most of my rolls. Is I tend to roll option positions that haven't done much since I've been holding them. So for example, I put on a short put at 45 DTE. Now my rules say take it off at 21 DTE. So I put it on at 45 DTE. 21 DTE rolls around. I take a look at my short put. I'm not really up much money or down much money. It hasn't really done much for me. But if I'm still bullish in that particular underlying and it meets certain criteria, like does it still have high IV rank? Because I like putting on short puts with high IVR. If the IVR is still high and I'm still bullish on that underlying, then I'll roll it out to the next month. Basically, I'm putting on the same trade again, right? So I'm moving it back to the next month out, which is closer to that 45 DTE mark. I'm essentially, this position hasn't really done anything. It's basically, I'm closing this position for really a small gain or a small loss, pretty much break even. I'm just putting it on for the next month because I still have the same assumptions in that underlying. Let me show you an example of this. If I go to my trading platform here, of course, I'm using TASTYTRADE as my trading platform, and I've got this position here. I don't really have to roll anything right now. But if I had to roll a position, this is probably the one that's closest to a roll because I put on this AMD short put 21 days ago. So this position has been open 21 days. It still has 36 DTE. So it's 36 days left to expiration, which is still, another 15 days before I need to manage it. But let's imagine it's already 21 DTE and today's the day, 21 DTE. I need to either close this trade for a winner or close it for a loser or roll it. Well, in this case, you can see the position has only made $1 since it's been open. This position has been open for 21 days, 3 weeks, right? And it has not moved at all on me. And it's possible I wait 2 more weeks and the position still hasn't really moved up or down. I'm not really a big winner. I'm not really a big loser. It really just hasn't done much. But if I'm still long-term bullish in AMD, and if AMD still has decent high IVR, so I want a high IV rank of at least 30 or more. In this case, it's a little below 30, it's about 25, but let's imagine it's 30 or more at 21 DTE. And what I do is I will just roll this position. So to roll a position, at least in TASTYTRADE, you just right-click on the position, and you have these options here, quick roll, which I believe just takes your existing position, puts it in the next monthly cycle. You have roll expirations, which allows you to pick an expiration cycle. So instead of just defaulting to the next monthly cycle, you could go to a weekly cycle. You could go to the next monthly cycle. You could go to 2 monthly cycles out all the way at 99 DTE. You also have this menu here where you can roll the strikes either up or down. So let's imagine in this scenario that I'm ready to go ahead and roll out to the next month. I would choose roll expirations. I would go to the next monthly cycle. You see the ones with W beside them, these are weekly cycles. There's better liquidity typically in the monthly option. So I'll go to 64 DTE in this case. And you can see it told me that I would receive a $2.07 credit to roll that option further out in time. Why do I get a credit for rolling? There's more time for this option to go against me. As an option seller, I have to get paid for that because I'm taking on more risk essentially. So you're always going to typically get a credit when you roll, at least when you roll out in time. Now, when you roll your strikes, you can either roll for a credit or a debit, depending on, are you moving your strike further out of the money? If you're moving your strike further out of the money, which is you're making your strike safer, right? You have to pay a debit for that. If you move your strike in closer to at the money, right, that's putting on more risk. You have to receive a credit for that. Now, I can show you this. Since I'm receiving an extra $2.07 credit, let's imagine that I don't want to just roll this 140 strike out to the 64 DTE cycle. I also want to roll it down away from the at the money. I want to, it's a 20 delta put, which I don't mind selling a 20 delta put, but I'd really like to get that thing maybe to a 15 delta put. So I'll go down $5, right, to the 135 strike. You see, now I'm only receiving a $1.05 credit instead of a 207 credit, right? I had to give up $1 in premium for that roll, but I'm still receiving extra credit on top of the credit that I received for the original position. Here's the thing. I received some money for the original position. How much did I receive for the original position? Let's go look at the trade price here. So when I sold that 140 put, I received 125 credit. That's the trade price. So now when I roll, if I roll out in time, the 64 DTE, and down in price to 135, I receive an extra $1.04 credit for rolling that. So now, my max profit's not 125. I'm actually going to make potentially a max profit of $230 on the roll. And naturally, you're going to ask, well, heck, if you actually receive credit, you receive premium every time you roll, why wouldn't you just roll out in time all the time? Well, you can, but typically, again, you're taking on more risk because you're giving yourself more time to lose on that trade, because again, you're opened up to unlimited risk on a naked option like a short put or a short call. So you are taking on more risk. That's why you get paid. But what I like to do, typically I like to take that extra credit I would receive. Again, if I just rolled that 140 put out to the 64 DTE cycle, I had $2.07 of extra credit I could receive. I like spending all of that and getting as far away from at the money as I can. So I might go all the way down to the 130 strike. I'm still receiving a 30-cent credit, but it's essentially my same position. I received a $1.25 originally. Now I'm going to receive an extra 30 cents. So I'll have a $1.55 max profit on the trade. I get a much better strike. Now I'm all the way down at the 10 delta put, $10 lower than where I was originally. I also have 64 days now, 64 DTE. And if I manage the position at 21 DTE, I essentially have 43 days in this position until the next time I manage it, assuming I don't make 50% or more of my profit. If I make 50% or more of my profit before the 21 DTE mark, I'm just going to take this thing off for a winner. So that's rolling. That was an example roll. I'm not ready to roll that position because, again, I typically manage my trades at 21 DTE. I still got some time left in this put. But if that 21 DTE mark rolls around and I still haven't really won or lost on this position, if it's still just kind of hanging out, then I will definitely roll out in time, and I probably will roll down the strike. I'll spend that extra credit I could receive rolling out in time. I'll spend that money to also roll down in price to give myself a little more cushion. Probably the most common trades that I roll are strangles. For example, I've got this strangle here in XBI, and yes, I have actually rolled that thing 10 times. I've been in this trade since early February, and it's the middle of June, right? I've rolled this thing so many times. I've rolled the strikes up, I've rolled the strikes down, I've rolled out in time. If I go to the chains here, if I go to the little right sidebar, the little pop out, let me move my head here and go to chains. And you can see here is the options chain. This is the position, right? This position here started February 15th. I put on a 83.105 strangle. And then the position went way against me, so I rolled, and then I rolled again, and then I closed the call because one day the stock went way down and one of my calls was nearly 100% winner. I closed it, opened a new call, then that call went against me. I ended up having to roll. It's just, this has been a whipsaw. XBI, which is the biotech sector ETF, has gone up and down kind of violently in the last few months. You can see, if we go back to February, so I started here and it way up, and then it came crashing down, then went up, and it's kind of, it has a lot of movement. And this has caused me some heartache. So rolling strangles, typically what I do, and let's imagine that the strangle has gone against me. Typically on these, I'll roll out in time if I need to, or I'll roll the strikes up or down. Now let's imagine I'm going to roll out in time. So I'll go to the next monthly cycle, the 64 DTE cycle in this case. Again, just as an example, and it's picks the 88 and the 100 strikes. Now my original strikes, let me see, were 88 and 102, but it can't do a 102 strike in the next monthly cycle because the 102 strike doesn't exist, so it goes to the closest one, and it actually went down. You can see 88, 100 in the 64 DTE cycle, I'll receive a credit of $2.05, but typically, again, I don't want to get extra credit. Really, I want to make myself a little safer. So this 100 call here, let's go to the 105 call. Now I'm only receiving about $1 credit, but that gets me all the way to 16 deltas on the call side. So I feel pretty safe on the call side. I still have $1 of credit to play with, so I might pull this 88 call maybe down to a 85 call. Now I'm receiving 31 credit, 31 cent credit, which is nice. I'm still receiving a little extra credit. You can see my max profit on this strangle is $1.71. That $1.71 credit is actually a pretty good credit on this size product. That's currently trading around $93. I probably have a buying power reduction of about $1,000, probably $1,000 to about $1,200. And again, I have potentially a 173 max profit. So, that would be a pretty cool roll. Again, if I needed to make such a roll, I don't actually need to roll this position right now because I've got plenty of time left in the trade, and it's not really doing much for me. Now, of course, all those scenarios I just showed you with these short option trades, rolling out in time and rolling just a little further out of the money, I was always trying to roll them for a credit. Now, again, I could roll them for a credit because I was taking on more risk in all of these trades. Anytime you do anything where you take on more risk, you get paid for it. Now, if I made myself safer, if I really made myself safer by rolling way out of the money, then I have to pay a debit for it, because then, you don't get anything for free. For example, this strangle and XBI, let me roll out in time. And now what if I really want to get way out of the money? So this 100 call, I'm going to take it all the way to 110. Now I'm only receiving 40 cents credit where I was receiving $2. Maybe this 88 strike put, I want to roll it all the way down to 82. Now, because I've really taken off a lot of risk, right? I've made myself so safe here, I have to pay for that privilege. Right now, I have to pay a 52-cent debit. Right now, my max profit, instead of the 172 where that roll before I was getting a little bit of credit, now I'm paying quite a bit of a debit. I'm actually reducing my overall max profit by, again, making myself quite a bit safer on the trade. So this is one of the things with rolling, is anytime you take on more risk, you have to get paid for it. Anytime you take off risk, you have to pay for it. So that's just some of the basics of rolling options. Now, that still doesn't answer the question that new options traders often ask, is why bother rolling? Why not just close your existing position and open a brand new position? That's a good question, and that's essentially what rolling is. Rolling is closing this position you're in right now and opening a new position, but it does it all in one trade, and it keeps up with those trades, and it sees them as far as their P&L as one trade. Where if you close a position, that position's closed, it was either a winner or a loser, that's the P&L on it, and then you open a new position and you start a new kind of P&L chain on it, where your rolls, like those 10 rolls in that XBI strangle that I just showed you, it sees all of that as part of one trade, and eventually I'll close the trade. I'll actually close it rather than roll it, and then all the rolls are calculated together for the P&L, and I either win or lose on all 10 of those rolls as one trade. Essentially, rolling, the only difference with rolling rather than closing a position and opening a new one, it's all the accounting, right? It sees it all as one trade. In the end, your P&L is all the same at all. It doesn't make a difference money-wise. It's just how it's displayed on the screen when you go and look at each individual trade. Again, if you're tracking your trade, you want a good, accurate log, right? For example, that XBI strangle again, I want to see these positions here. I don't want to see them as 10 different trades, right? Even though I can see that, here's what I sold that strangle for, here's what I rolled it for, here's what I rolled it for, here's what I closed the position for at a loss, then I open a new one for a credit, then I rolled for a slight loss, then I rolled for a slight credit. Like, I can see them, but ultimately I want to know, what am I up on all 10 as one trade? And if I move my head, I get that information. That's what I'm currently up, or actually I'm currently down on those 10 rolls as one position. I'm currently down $6 for a trade I've been in for 4 months. I've been rolling forever. So again, rolling, it's essentially an accounting thing. Whether you roll or not, does it really make a difference? In the end, it's all the same. It's 6 of one, half dozen of the other. Now, if you want to learn more about the basics of options trading, including rolling options, as well as my favorite option strategy, the wheel option strategy, check out my book, The Super Wheel Option Strategy, available on Amazon. Peace, guys.